After 7 years of trading in Forex, crypto, and stocks, I've discovered 5 key steps. Stick to them, and losing will become almost impossible. Because these 5 steps are like links in a chain. Miss even one, and you'll probably fail. But master all 5, and your chances of success will skyrocket to a level you won't even believe. Especially since step number 5 is something you'll almost never hear about anywhere else. Step 1. How to identify market trends. Before entering any trade, we need to know exactly what kind of trend the market is in. Is it an uptrend or a downtrend, or neither of these, meaning the market is moving sideways? We have lots of indicators and strategies to determine market direction, but one of the most effective, as experience shows, is Ichimoku. But how are we going to use the Ichimoku? First, we bring up our chart here. We've got the gold chart as an example. Then we go to the indicator section and type Ichimoku into the search bar. After that, we select the Ichimoku Cloud, and once we've done that, you'll see the indicator appear right on the chart. Now, there are a few settings we need to adjust. By default, it's fine, but let's set them up just to be sure. We'll put the conversion line to 9, the baseline to 26, the leading span B to 52, and the lagging span to 26, which we don't use that often anyway. In the style section, make sure you set the conversion line color to red and the baseline to blue. Once you do that, hit OK, and you're all set. Now the Ichimoku indicator is ready on your chart for you to use. So how can we actually use the Ichimoku to figure out if a chart is in an uptrend or a downtrend? For example, let's say we're looking at the gold chart on a 1-hour time frame, and we want to trade on that 1-hour time frame. The first thing you do is actually step 1 time frame higher. But that doesn't mean just going from 1 hour to 2 hours. Instead, you go about 5 times the original time frame. So if you're on 1 hour, you jump up to a 5-hour chart. If you were on a 1-minute chart, you jump to a 5-minute chart. But since we don't have a 5-hour chart, we'll just use the 4-hour chart as a reference. So we go 1 time frame higher, meaning roughly 4 or 5 times the original time frame. After we do that, we use the Ichimoku to see where the price is standing. As I mentioned, we have 3 main elements: the red conversion line, the blue baseline, and the Ichimoku Cloud. If the price is above all 3, that indicates we're in an uptrend. Another thing to check is that the red conversion line is above the baseline, and the baseline is above the cloud. That tells us the trend is strongly bullish. When the trend is bullish, we only look for buying opportunities, and we don't take sell trades. So we check the 4-hour time frame, and then we come back down to the 1-hour chart and wait for our entry point. That's our next step. This channel is just getting started, and your likes, comments, and subscribes mean the world to me. They keep me motivated to create better content every week. When we're in a downtrend, we basically flip all the conditions we had for an uptrend. What does that mean? Well, just like we did before, we go 1 time frame higher here. We're using the 4-hour chart. We check if the price is below the red conversion line, below the blue baseline, and below the Ichimoku Cloud. If that's the case, then we're in a downtrend, and we should look for selling opportunities. And just like before, if that red line is below the blue baseline, and the baseline is below the cloud, that means the trend is really strong to the downside. Then we just wait for a good sell setup on the 1-hour time frame. So, how we actually recognize when the market is in a sideways trend? This is something you won't find in a lot of resources, but it's really important. When the market is moving sideways, you shouldn't open any trades, no buys, no sells. You just stay on the sidelines and watch until a clear uptrend or downtrend forms, where you can actually find a good position. This is something not many people talk about, but it's interesting to know that most traders' losses actually happen during these sideways phases. So what do? Let's say we're trading on a 1-hour time frame. We'll go up to the 4-hour chart to check if the price was previously in an uptrend above the red conversion line, blue baseline, and the Ichimoku Cloud. If the price starts dropping below the conversion line, then below the baseline, and then below the cloud, that's when we enter a sideways market. And in a sideways market, we don't take any trades. Now, to confirm this, we go back to the 1-hour chart and see how the price is behaving. You'll notice it's just moving up and down without a clear direction. Any position we'd open here would have a high chance of getting stopped out. So we mark the point where the sideways trend ends. And once the price moves above all 3 indicators again on the 4-hour chart, we know we're back in an uptrend and can look for a buy. The key takeaway is to identify these sideways periods and avoid trading until a new trend forms. Step 2. How to find the entry point. So to figure out exactly where we should enter a trade, we need to identify where the uptrend or the downtrend is. In an uptrend, we're looking to buy, and in a downtrend, we're looking to sell. And as you know, we need to get out of that sideways range first. So when exactly do we exit the sideways trend? It's when the price moves above all three of those key parameters we mentioned. How do we spot that? We jump up to the 4-hour time frame. The moment a 4-hour candle closes above all three lines, the red conversion line, blue baseline, and the Ichimoku Cloud, that's our signal. Once that candle closes above all three on the higher time frame, we know we're entering an uptrend, and we can take a buy position at the start of the next candle. For a sell, it's just the opposite. On the 4-hour time frame, if a candle closes below all three lines, that's our cue to enter a sell position. Step 3. How to set take profit and stop loss. So when it comes to setting our stop loss and take profit, here's what we need to do. We're going to use the exact candle where we got confirmation on the 4-hour time frame. The lowest price of that confirmation candle becomes our initial stop loss when we open the trade. Once we've opened the trade and set that stop loss, we switch down to the 1-hour time frame to set our take profit. We use a trend-based Fibonacci tool from our stop loss level to our entry point. The 100% Fibonacci level is our first take profit target, and we never close the trade before reaching at least that point. Then, our next take profit levels can be at the 161.8% Fibonacci level, the 200%, and so on. That way, we can keep extending our take profit targets as the trend continues. Now, how do we maximize our profit and manage the trade for bigger gains? We go back to the 4-hour time frame and gradually move our stop loss upward. Each time a new 4-hour candle forms and the trend is still going in our favor, we move the stop loss up to the low of the previous candle. We keep doing this step by step, locking in more profit as we go, until eventually the price no longer makes new highs and hits our stop. This way, from a single trade, we can achieve really substantial profits. Step 4. When to open a new trade. So when exactly should we re-enter a trade? That's a super important question, because a lot of times we close a trade in profit, and then we jump right back in and end up taking a loss that wipes out our gains. So, the key point is knowing when to get back in. For example, after we've taken a buy trade and closed it with a profit, we absolutely need to wait for the market to go into another sideways phase. We let that sideways period play out, and only then look for our next buy or sell opportunity, just like we explained before. So let's say the market goes sideways here for a bit. Once we see that sideways range complete, and we get a new signal, like on this candle right here, conditions are perfect for another buy. And as you can see, we can grab another nice profit from that move. Then, we wait again for the next sideways phase to finish before deciding if we should buy again or maybe prepare for a sell if the market's going to turn downward. It's all about being patient and waiting for that right setup. Step 5. Follow the trend, never fight it. The most important reason most traders end up taking losses is that they trade against the trend. What does that mean? It means if there's an uptrend, some traders think, well, the price has already gone up a lot, so I'll just sell here because it's bound to drop. Or if there's a clear downtrend, they think, hey, it's fallen so much, it must be a good time to buy now. In reality, that's a common mistake that causes most losses. You should always go with the trend. If it's an uptrend, look for buying opportunities. If it's a downtrend, look for selling opportunities. Never fight the trend. Now, in this video, I showed you how to use the Ichimoku indicator to identify the trend. But if you have another method you prefer for spotting the trend and figuring out your entry and exit points, that's totally fine. Just follow all these steps, and you'll drastically reduce your losses and increase your profits.